Everyone wants to get rich fast. Most people won't say it directly, but you can see it in how they behave. Constant trading, jumping in and out of positions, watching charts all day, chasing the next opportunity. It feels like progress. It feels like you're doing something important. It feels like you're moving forward. But in reality, for most people, trading is the fastest way to stay broke. Not because markets are unfair, not because opportunities don't exist, but because the way most people approach trading is fundamentally misaligned with how wealth is actually built. And that gap quietly destroys results. The illusion of progress. Trading gives you constant feedback. You click buy, you click sell, you see instant results, profit, loss, movement. It creates a sense of momentum, a sense that you're actively shaping your financial future. But activity is not the same as progress. And that's where most people get trapped. Because the brain associates motion with improvement. If you're doing something, it feels productive. But in financial markets, excessive activity often works against you. Each decision introduces risk. Each action creates friction. And over time, those small frictions compound. Not in your favor, against you. The illusion of control. One of the biggest psychological traps in trading is control. You feel like you're in charge. You can enter anytime, exit anytime, adjust anytime, react instantly. It feels empowering, but the market doesn't operate on your timeline. It doesn't respond to your decisions. It doesn't care about your intentions. So what starts as control slowly turns into reaction. You begin responding to price movements instead of following a strategy. You check charts more often. You react faster. You second-guess decisions. And before you realize it, your behavior is being dictated by the market, not by your plan. And when your decisions are reactive, your results become inconsistent. Why most traders lose? There's a structural reason most traders struggle. Every trade carries a cost. Fees, spreads, slippage, taxes. These are not dramatic individually, but repeated over time, they become significant. Imagine making hundreds of trades a year. Even small inefficiencies begin to stack up. But the real cost isn't just financial. It's emotional. Trading exposes you to constant feedback loops. Wins create confidence. Losses create doubt. And losses always feel stronger than gains. This emotional imbalance leads to behavior changes. You try to recover losses quickly. You increase risk. You abandon your original plan. You chase opportunities. And once you enter that cycle, it becomes difficult to escape. Because now you're not just trading the market, you're trading your emotions. The hidden drain, attention. There's another cost most people don't consider. Attention. Trading consumes it. Charts, indicators, news, social media. Your focus gets pulled in multiple directions, and attention is a finite resource. The more you spend it on short-term noise, the less you have for long-term thinking. You start optimizing for immediate outcomes. The next move, the next trade, the next opportunity. And that shift in thinking is dangerous. Because wealth is not built in short bursts. It's built through long-term consistency. And consistency requires clarity. Clarity requires focus. And focus disappears when attention is constantly fragmented. Holding feels wrong but works. Now, here's where things get interesting. Holding feels uncomfortable. It feels passive. It feels slow. Sometimes it even feels like you're missing out. Because nothing is happening. At least, nothing visible. No constant feedback. No immediate results. No stimulation. But beneath the surface, something powerful is happening. Compounding is working. Compounding doesn't need constant input. It needs time. When you hold quality assets over long periods, growth begins to layer. Returns generate additional returns. Momentum builds gradually. At first, it feels insignificant, but over time, it accelerates. And eventually, it becomes the dominant force. but only if you allow it to continue uninterrupted. The patience gap. The real difference between traders and long-term investors isn't intelligence. It's patience. Traders want immediate validation. They want to know they're right. They want to see progress quickly. Investors accept delayed outcomes. They understand that time is part of the strategy. This creates a gap, a patience gap. Most people cannot tolerate waiting. They feel the need to act, to adjust, to optimize, and in doing so, they interrupt the very process that creates wealth. Because compounding requires stillness, and stillness feels unnatural in a world that rewards activity. Volatility versus permanent loss. One of the biggest misconceptions in investing is confusing volatility with loss. Prices move up and down. That's normal. That's expected. But movement is not the same as losing money permanently. Loss only becomes real when you exit at the wrong time. Traders react to volatility. They see red numbers and feel urgency. They act to protect themselves. But often, that protection locks in losses. Long-term investors think differently. They expect volatility. They plan for it. They understand that short-term declines are part of long-term growth. So instead of reacting, they remain consistent. And consistency allows recovery. The cost of missing the best moments. Markets don't grow evenly. A large portion of returns comes from a small number of strong days. If you're constantly in and out of the market, you risk missing those moments. And missing just a few of them can significantly impact your long-term results. This is one of the biggest hidden costs of trading. You might avoid some downturns, but you also miss major upswings. Holding ensures participation, and participation is what allows compounding to work fully. Generational wealth requires a different mindset. Trading focuses on short-term gains. Generational wealth is built on long-term stability. Families that maintain wealth don't rely on constant activity. They rely on systems. They invest in assets that grow over time. They hold through cycles. They think in decades, not days. Because the goal is not to win every opportunity. The goal is to build something durable, something that survives uncertainty, something that can be passed down, and that requires discipline. Consistency, patience, not constant action. Emotional stability is an advantage. Holding doesn't just change your financial outcomes. It changes your mental state. You're not reacting constantly. You're not stressed about every price movement. You're not glued to charts. You operate with clarity, and clarity improves decision-making. When your strategy is long-term, your mind becomes calmer, and that calmness becomes an advantage, because emotional stability leads to better financial behavior. The reality of trading success? It's important to be clear, trading is not impossible. Some people succeed, but it requires a specific combination of skills. Discipline, experience, emotional control, time commitment. It's not casual, it's professional, and most people approach it casually. That mismatch leads to losses, because they're competing in a high-level environment without the necessary preparation. The smarter strategy, for most people, the smarter path is simple. Invest in strong, proven assets. Hold them over long periods. Add consistently. Avoid unnecessary decisions. Let compounding do its work. This approach doesn't feel exciting. It doesn't create constant stimulation, but it works. And more importantly, it's sustainable. The identity shift. At some point, the shift becomes internal. You stop seeing yourself as someone trying to make money and start seeing yourself as someone who builds wealth. That identity changes behavior. You stop chasing opportunities. You start selecting carefully. You stop reacting to noise. You start focusing on long-term value. You stop measuring success daily. You start measuring it over years. And over time, that shift produces dramatically different results. Final truth. Trading feels like progress. Holding feels like patience. But only one consistently builds wealth. Because wealth is not built in moments. It's built over time. Through discipline, through consistency, through the ability to stay invested when others are reacting emotionally. So if you find yourself constantly trading, constantly adjusting, constantly chasing, ask yourself one question. Are you building wealth or just staying busy? Because for most people, trading creates activity, but holding creates wealth. And if you look closely at the people who actually build lasting wealth, their strategy often looks boring from the outside. No constant buying and selling, no reacting to every headline, no obsession with daily price movements, just quiet consistency. They choose strong assets carefully. They commit for the long term. They allow time to do the heavy lifting. And most importantly, they stay out of their own way. Because one of the biggest risks in investing is unnecessary interference. Because every time you act without a clear reason, it's interference.